You're 24. You just read a book called The Intelligent Investor. You feel very smart. You are not yet smart. You will be in about 11 years, once the boring part actually sinks in. Here's the boring part. Buy good companies. Hold them. Do nothing. Everyone skips that. Everyone wants the part where you get rich fast. Warren Buffett bought his first stock at 11. He calls it late. Not because he wasted his childhood, because he thinks starting at 11 instead of 8 cost him serious money. That's how seriously he takes time. You don't have Buffett's 80 years. You have maybe 40 good investing years left. That's fine. The math still works. It just works slower, which nobody wants to hear. Let's talk numbers. $10,000 invested at age 25, left completely alone, averaging the market's historical return, about 10% a year before inflation. By 65, roughly $450,000. Same $10,000 invested at 35 instead of 25. By 65, roughly $175,000. 10 years. $275,000 difference. You didn't do anything different except wait. Waiting is the most expensive decision in investing. And nobody tells you that at 25, because at 25, nothing feels expensive yet. Buffett's actual net worth math is even more brutal. Over 99% of his wealth was built after age 50, not because he got smarter after 50, because compounding needs decades to actually show up. And decades is the one thing you cannot buy back. Here's rule 1. Buffett says it constantly. Rule number 1, never lose money. Rule number 2, never forget rule number 1. People hear that and think he means never take risks. That's not it. He means something narrower and much more useful. Don't do permanent damage to your capital. A 50% loss requires a 100% gain just to break even. Lose half your money? You now need to double what's left just to get back to zero. That math is why avoiding big losses matters more than chasing big wins. Here's rule 2. Price is what you pay. Value is what you get. A stock going up doesn't mean it's a good investment. A stock going down doesn't mean it's a bad one. Most people get this backwards. They buy because something's rising. They panic sell because something's falling. Buffett does the opposite on purpose. When quality companies go on sale during a crash, that's not a warning sign. That's a discount. 2008. Market drops 37% in a single year. Everyone's panicking. Buffett writes an op-ed titled, "Buy American, I Am." He starts buying while the world is selling. Within 5 years, those purchases are worth multiples of what he paid. He wasn't smarter than everyone else in that moment. He was calmer. Calm is a strategy. Most people don't believe that until they've lost money, proving otherwise. Here's rule 3. You don't need to be an expert in everything. You need a circle of competence. And you need to know exactly where the edges of it are. Buffett avoided tech stocks for decades. Missed early Amazon. Missed early Google. People called it a mistake. He called it discipline. He didn't understand those businesses well enough to judge them properly. So he stayed out, even while everyone around him got rich on stuff he didn't touch. Then Apple. He bought it late, in 2016. Once he understood it wasn't a tech company to him, it was a consumer products company with insane customer loyalty. That one call is worth more than $100 billion in gains. Staying in your lane until you actually understand a new lane is not weakness. It's how you avoid the expensive kind of confidence. Here's rule 4, and this is the one that ruins people. Time in the market beats timing the market. Missing the 10 best trading days over a 20-year period cuts your total return roughly in half. 10 days out of thousands. And you don't know in advance which 10 days they'll be. Nobody does. The people who try to jump in and out, catching the highs, dodging the lows, almost universally underperform the people who just stayed invested and did nothing. Doing nothing correctly is a skill. It's the hardest skill in finance because every instinct in your body screams at you to act when the market drops. Here's rule 5. Compound interest is the whole game, and almost nobody respects it until it's too late to fully benefit. $1 invested at 10% annual return doubles roughly every 7 years. Age 25 to 65 is 40 years. That's not 5 doublings, it's not 6. Run the actual math, and $10,000 becomes roughly $450,000. Not because of one great decision, but because of 40 years where you didn't touch it. The tragedy of compounding is that it's front-loaded with boredom and back-loaded with results. Year 1, $10,000 grows to $11,000. Underwhelming. Year 35, that same growth adds 6 figures in a single year. Same percentage, wildly different dollar amount. Most people quit during the boring years, right before the interesting years start. Here's the part that applies directly to 2026. Nothing about any of this has changed. Not inflation spikes, not AI disruption, not whatever headline is scaring people this month. The mechanism is identical to 1965. Buy quality, hold long, ignore noise, let time do the multiplication you can't do yourself. Buffett's own advice to regular people, the ones without hedge funds or research teams, is almost insultingly simple. Buy a low-cost S&P 500 index fund. Keep buying it regularly. Don't check it constantly. Don't sell during crashes. Let it run for decades. That's the entire strategy that built one of the largest fortunes in human history, boiled down for people without a research department. Buy the whole market, cheaply, and then get out of your own way for 40 years. Nobody wants to hear that it's actually that simple. Simple doesn't sell seminars. Simple doesn't get clicks. Simple just quietly works, decade after decade, while everyone chasing something more exciting quietly underperforms it. You're 24 again in this story, reading the same book Buffett would tell you to read. The advice hasn't changed since he was your age. It's still boring. It's still correct. And in 40 years, when the boring years finally turn into the interesting ones, you'll understand exactly why he never stopped repeating it.